QuickBooks Online 2025 Accounts Receivable Aging Reports. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody. Looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software and then verify that we're not a robot by just clicking that box. All you have to do, I'm not sure that's going to keep out the AI. They're getting really smart. I mean, honestly, like 10 years ago, they were hacking into my phone. You think that little checkbox, the little checkbox is going to keep us safe in our safe human zone from the AIs? I don't feel like whatever. Anyways, let's go down to the reports on the left-hand side. We're in the standard tab. Open up the major financial statement reports like we do. We're going to right-click on the balance sheet, open a link in a new tab. Right-click the profit and loss, open a link in a new tab. Let's go to that middle tab, close up the hamburger, and then we'll change the range to a 2-year time frame. 01/01/24 tab, 12/31/25 tab. Select the drop down to see it in years. Run it to refresh it. 24/25 side by side. Let's tab it to the right. Close up the ham boogie again. Change that range. We're going from 01/01/24 tab, 12/31/25. We want to see the drop down in years to run it and refresh it. Side by side, 24 and 25 once again. So these are the two major financial statement reports. Then we looked at the statement of cash flows, which is kind of like the third major financial statement report, although far less popular than and useful or things that we use most often than these two reports. And now we're going to look at some of the other types of reports, remembering most other reports are going to give us more information about one or multiple line items of these two financial statement reports. And if we think about it that way, the other reports get a lot less overwhelming because there are a lot of them. But they're all, if we think of them as variants or more information about these reports, simplifies things a little bit. So if we go back to the balance sheet here, we're now going to be considering the accounts receivable generally, looking at reports that give us more information about it, noting that accounts receivable is an accrual type of account, meaning if you're in a simple type of business with regards to revenue generation and collection, such as gig work, for example, in which case you just get money going right into your bank account from a platform, possibly recording it with a bank feed, a deposit form, then you're not going to have to deal with accounts receivable. If you're at a cash register and you're at a food truck or a restaurant or something like that, you get paid at the same point in time. It's still more complex, even though it's kind of on a cash-based system than a gig work situation, but at least you don't have to deal with accounts receivable. You don't have to call people up and say, hey, look, I did work for you before and you haven't paid me. Could you please pay me? And they're like, well, what have you done for me lately? Why would I do anything for you lately? You didn't pay me for the thing I did before. That's why I'm calling you. And you try to collect on the accounts receivable. It's a difficult thing. It's painful. It's annoying. But that's what we have to deal with. So we can look at subsidiary reports tracking the accounts receivable, which we would need if we do the work first, which is driven by industry, such as if you're a bookkeeper, a landscaper, a lawyer. Typically, you have to do the work, bill them for the work that was done, for example. All right, so normally we're going to go to the first tab and we track that information by going to possibly the sales tab, and we track it internally by looking at, for example, all sales forms, and we can look for the open invoices this way, thusly. We can look for the invoices, or we can more likely go to the invoice tab up top and look for those open invoices this way, sorting them, or we can go to the customers tab and we can sort internally this way and say we want the invoices possibly overdue or the open invoices. And then, of course, we can send statements, selecting the plus button and sending out statements to try to collect on the outstanding accounts receivable, which will basically summarize possibly multiple invoices, right, as an attempt to collect on it. Now, we want to note that these open invoices should tie out to what's in accounts receivable, which you might be able to see if you go to the invoices on this tab, for example. Sometimes they give us a total down here. They didn't give me a total down here. So that's harder to see sometimes though. So we want to keep that in mind, that if I add up all the open invoices, that you would expect would add up to the amount in the accounts receivable. We can prove that to ourselves with actual reports breaking out the accounts receivable by outstanding balance. Outstanding balances from customers will be there because of invoices which have not yet been paid. So let's go to the first tab and check those report types out. We're on the reports on the left-hand side. In the standard tab, we scroll down and who owes you money. So that header tells you that we're basically talking about accounts receivable, because when would people owe us money as a business? When we did work and they haven't yet paid us for the work, typically. So all of these reports are usually, the first thing that should come to mind is they're going to be dealing with accounts receivable in some way. So we've got the accounts receivable aging summary. We've got the accounts receivable aging detail. We got a collections report tracking us trying to collect on the receivables, the work we have done in the past. Customer balance summary, customer balance detail. These two are going to be similar, one giving, of course, more detail about the activity, but are the most direct subledger type of report. Then we got an invoice list. Invoices are the things that increase accounts receivable. So if they're outstanding invoices, you would expect that would sum up to what the AR or accounts receivable balance is. Invoices and receive payments. Now the receive payments represents the paying off of the reports. So this could be thought of kind of like as a more detailed accounts receivable report still, because now it's going to show you not only the invoices that have not been paid, but possibly give you detail about the receive payment forms, the decreases. And then the open invoices, which is the open invoices should be the same thing usually as the customer balances, the customer balance detail, because it's going to show you the open invoices being the balances that they owe you because they haven't yet paid those invoices. The statements are the things that we send out in order to try to collect on the invoices instead of sending out a follow-up invoice, because the statement would summarize multiple invoices if there's more than one outstanding. And then we've got the terms, which are just on the invoice themselves. When do we want to be collected by? Unbilled charges. These are going to be charges for items that we wrote on expenses that have not yet collected on. Unbilled time. Similarly, these are time that we incurred, that we put into the system that we're going to bill on but have not yet invoiced or billed for them. So the primary subledger reports are going to be these two. Now, when I say subledger report, note that from an accounting standpoint, textbook standpoint, you would have accounts receivable over here, and then each of these accounts have been constructed by what we would call a general ledger type of account, which here we can think of as the transaction detail. So if I go into this report, for example, drill down on it, this report is what we might call a general ledger type of report, which they call a transaction report. And it's going to be breaking out the activity, what constructed the imbalance of this account by date. So it's going to be sorted by date, and then we have the forms and so on and so forth. That's great, but doesn't give us enough information for some kinds of accounts. Some accounts we need more information, such as the accounts receivable account. We also need to know the amount not just by date, but by who owes us the money. So if we need to restructure the data in a different organized form, from an accounting standpoint, we usually call that like a subledger type of report, as opposed to the general ledger, which every account has and is broken out by date. So the primary subledger report would be just breaking it out by who owes us the money. So if I go back on over here, we can do that by opening either one of these two, the customer balance summary or the customer balance detail. Let's look at the detail one because it's more detailed. We'll open it up, right click and open it. And let's see, let's close up the ham boogie. And so it's doing for all dates. So it's as of the end of 2025, noting that there's no date range here. Well, it's giving us all dates. if we're just looking at the ending balance, then it would be like a balance sheet type of report. Remember, in the balance sheet type of reports where we stand as of a point in time, how much money they owe us as of a point in time. Whereas the income statement is a performance type of report. It needs a beginning and an end, similar to how far did we drive in a day. That means in a 24-hour time period, which means we need to reset the odometer. So now this subledger report can be thought of as a balance sheet type of report. How much do people owe us as of a point in time? And then it gives us the detail of the open invoices. It gives us the date of the open invoices, but it doesn't really matter what the date is. The invoice is going to show up here. If the invoice has not yet been paid off, that means it's open. So it gives us the information by who owes us the money, by customer, in other words. And the bottom line, if we were to sum it all up, is $5,281.52. So that should tie out to what's on the balance sheet in 2025, $5,281.52. So that's a classic subledger. The subledger should always tie into the general ledger account, or the amount, or the account on the financial statement, in this case, the balance sheet account. Now, you might ask, what if it doesn't? What if it doesn't tie out? Well, in QuickBooks, it almost has to. It's almost never going to not tie out. Why? Because QuickBooks is going to force you to add a customer every time you hit accounts receivable. This is why the accounts receivable account has its own account type, meaning when I create the accounts, I don't just put this under other current assets, which is what it would normally be called from a financial reporting standpoint, but rather it's in there as an accounts receivable type of account. Why? Because the system's going to treat it differently. It's going to say, hey, I'm going to generate a subledger based on this account. And not only that, I'm not going to allow you to post anything to accounts receivable if you don't add a customer. Why? Because then it'll throw off the subledger, and the system's going to give you an internal control, not allowing you to throw off the subledger. Now that could be useful, although it does cause problems, as we will see when we do adjusting entries at the end of the period, when we would rather not post something to the subledger report because we don't want to mess up the internal activities of the bookkeeping system. We would rather just do an adjusting journal entry without hitting the subledgers. But we'll deal with that later. For the most part, it is a useful tool, right? It's useful that it doesn't mess up the subledger. So remember the two forms then, whenever you enter something to accounts receivable, it's going to go up with an invoice, and it's going to go down when you have a receive payment from a customer. It's going to reduce it. You could hit the accounts receivable account, for example, with a journal entry. But if you do that, it's going to be kind of ugly because that's not the form you typically use. That's what we're going to do, however, if we have to do an adjusting entry, which we'll see in a future course or section in the adjusting entry process. All right. Now, note that this report is not as useful in practice, however, because even though it like shows me that it ties out, but all the rest of the information I kind of already have functionally from a bookkeeping standpoint internally. So if I needed to add this to like a report to give to my supervisor, or to add to a financial statement report, then great, I could use it. But from a normal day-to-day bookkeeping, I'm not going to go here. What am I going to do instead? I'm going to go internally, and I'm going to go to the sales tab, and I'm going to go where I was before. I'm going to track the accounts receivable here or by customer. So from an internal standpoint, that's not as useful a report. What might be more useful is the aging report. So let's go back to the reports over here and close up the ham boogie and scroll down to who owes you. So up top, we have the accounts receivable aging summary and then the accounts receivable aging detail. Let's look at this summary report. I'm going to right click on it and open that report. And let's take a look at it. So this one, why would this one be useful more? It's given this added level of information. It's breaking out how past due things are. This could also be found internally to see how past due things are. That's how we might sort things out to send out statements and whatnot. But I could also use this to determine if I want to make an allowance type of account, or try to determine when an account is going to become undue. So let me explain that fairly quickly here. So I'm going to say this is as of let's just make it 12/31/25. No, let's keep it at the same day. So I'm going to keep it at 02/05/25. So I have some time frame that's outstanding over here. So this is the total. It's still going to be breaking out by who owes us the money. The total still comes out to $5,281.52. That should tie out to what's on the balance sheet, $5,281.52. But it gives us this information by how past due it is. So the reason that could be useful is because when we think about what if I can't collect on the receivables? What if I have some deadbeats out there? There's always some deadbeats, right? So we can try to eliminate the deadbeats by having a higher threshold in terms of who we're going to do business with, which means we're going to lower our revenue typically because we're going to have less sales, but we're going to have less collection problems at the same time. Or the other strategy is we make sales easier, increase revenue, knowing that we're going to pick up more deadbeats, and then we're going to have to write off the accounts receivable for those losses where we did work for somebody and then they're not going to pay us, right? So the question is, well, how do I deal with those people that aren't going to pay us? Well, we could go into this report and look at the amounts that are past due. Now, we could do this internally as well. We could do this in our center over here. And as they become past due, we could then say, I need to write this off somehow, say to bad debt. If we use that method, that's going to be like what we would call the direct method. Now, the problem with the direct method, however, from an accrual standpoint, is that it's a way that you can imagine the financial statements could be distorted. So, for example, if I go over to my balance sheet over here and you say, okay, accounts receivable is at $5,281. But let's say I know that I've been doing business with a lot of deadbeats, right? And so I think there's a fairly high amount of people that aren't going to pay us because that's just the strategy that we took on. We increased sales by selling to people. That means we're going to increase the number of deadbeats out there that we sold to that are never going to pay us. So that number's too high. We're overstating the accounts receivable. Now, if I wait till I write it off, then you can imagine people they can bloat their numbers by saying, okay, I'm going to make sales that aren't really sales because I'm making them to deadbeats. I bloat up the balance sheet account and then I write them off at some later point to bad debt. But under accrual accounting, we would say, no, you have to estimate the amount of receivables that you think are uncollectible. And that's going to be the allowance method. So a lot of small businesses don't deal with the allowance method. But if you get into larger businesses, you'd have to deal with kind of the allowance method possibly. There's a couple ways you can estimate how much of the accounts receivable you are not going to collect. One is by looking at the revenue and saying how much of the revenue you think is uncollectible. The other is to look at the accounts receivable. How much of the accounts receivable is uncollectible? Well, here's the subledger for accounts receivable. How can I determine who's not going to pay me? How can I determine who the deadbeats are? We don't know who the deadbeats are, right? But I do know with some level of accuracy that the more past due the outstanding balances are, then the more likely we're not going to get paid on them. And I can determine that to some degree by looking at past data. So if I've been in business for a while, I can say I know what the trends are. These people haven't paid us for over 60 days past the due date. So it's likely we're not going to get paid. I can come up with some kind of estimate or percentage that's likely not going to pay us. I don't know who exactly is not going to pay us, but I know that someone's not going to pay us. And I can come up with my estimate there, and then I can make another account called allowance or for doubtful accounts, which would be a contra asset account, kind of like accumulated depreciation, reducing the assets for the amount that we estimate that's not going to pay us. The other side go into the income statement as bad debt expense at the point in time that we estimate it, not the point in time that we actually write someone off. And then when we write them off to the allowance for doubtful accounts instead of to accounts receivable. That way we try to do the accrual thing, right? So you might use it in that purposes. That's why that's one reason this report might be more useful that you would use even though you can for internal purposes. So then you've got the detail report. We've got the collection report. We looked at these invoices. We have the invoice and receive payments. Let's just take a look at this report to get a look and feel of it. Invoices and receive payments. So now if I did this for, let's do it for 2025. So 01 to 12 3125. So now it's giving us the detailed information. It doesn't give us the totals. So this is kind of cool, but it's kind of limited at the same time because it's giving us the activity per client of the invoices and payments, which is great. So we get more detail, but but it's not giving us the totals that is the amount due, which kind of makes sense because it would be difficult to, like if you were in business for 20 years, then are you really good? Do you really want to show all of the invoices and all of the payments for the 20-year time period? It would be a very long report. So therefore, you could do it. We just did it for 2025, and then it just shows the detail for 2025, but it's not going to give you all of the information. It's just showing the activity for that range, so it can't really give you the total. So that's going to be that one. Open invoices is just going to be basically should be similar, you would think, to the customer balance detail showing the open invoices. So that's the major gist of it. And then obviously when we determine that people aren't going to pay us, we've got to lay down the law, man. No, we don't lay down the law. We got to get the law up. The last people that were running this company, they laid down the law by putting the law to bed. And that's no good. I'm going to be waking the law up. The law's going to be waking up this time, and the law's going to be laying your non-paying down. That's what I'm talking about. The law's going to be standing up, and it's going to be you're going to be laid down by the law, and we're going to get our money. Anyway, that's that one.